Welcome Accounting Boffins, you with Ashraf Patel and the crew, and today's destination takes us to the balance sheet, the statement of financial position. Okay, now, how does a business describe its financial position accurately at the end of each financial year, right? Remember the income statement that we dealt with, spoke about the statement of comprehensive income. The balance sheet talks to the financial position of a business. In other words, we are saying here that you started off with your pre-adjustment trial balance, okay? You did your adjustments, all of this was done at the end of the year. You then completed your income statement, right? And after your adjustments were completed, you had what we call a post-adjustment trial balance, and then you go on to prepare your balance sheet. Now, what is very, very important is for you to know the layout and the format of your balance sheet. If you start off with interest income, so we're starting off with all the notes to the financial statements. Now remember, the interest income doesn't apply to the balance sheet per se, but it falls under the ambit of all your notes. So yes, it would be part of your notes, but remember, it applies to the income statement, where we dealt with interest income, and the three components that you have would be your income from your investments, namely fixed deposits, etc. 2, your interest from your overdue debtors, the interest that you have charged your overdue debtors, and 3, the interest from your current account, right? In other words, any interest that you've received on your current account, all of these would be added together and form your total, namely your interest income. Okay, like I said earlier on, this particular note, number 1, pertains to the income statement, not the balance sheet, but we are doing all the notes to your financial statements. Okay, the next one is your interest expense or your finance cost. Again, this one here also pertains to the income statement, has absolutely nothing to do with the balance sheet, but because we're dealing with all the notes, that's why we're just showing you these notes. So, what does your interest expense or your finance cost entail? It's your interest on your mortgage loan, right? Remember we said when we drew up that account of ours, the loan account, and we said that the interest was capitalized. Remember that interest figure there that you worked out or calculated would be the interest amount that you slot into here for your interest on your mortgage loan. Okay. Then, is there any interest that we are paying on our overdue creditors? Actually, we should not be having that, because in terms of our policy, we should be paying our creditors on time to ensure that no penalties are charged on our accounts. And then obviously, interest on bank overdraft, which is also a financing expense. And remember, like we said, interest income and interest expense appeared at the bottom of your income statement. All of these would be added to form the total for your interest expense. Right. So, note number 1 and note number 2, we dealt with them in today's lesson. They do not form part of the balance sheet, but rather the income statement. But we just thought it's a good idea to do all the notes to the financial statements so that you are au fait with all of them. Now we move on to the first one that is applicable to the balance sheet, namely your tangible asset note. A very, very important note. So make sure you understand it in its entirety. Right. Let's start with land and buildings first. You start off with your balance at the beginning of the year, right? Which is your carrying value. Now note that tangible assets, namely land and buildings, do not have depreciation, so your cost price at the beginning of the year will only increase if there's additions at cost or if there's any disposals. So when you're looking at tangible assets, remember, there's no depreciation. Your tangible assets do not depreciate. In fact, they appreciate in value, but it falls outside the ambit of your curriculum. So we'll just deal with the cost price of the tangible asset, namely land and buildings, any additions, any disposals during the year. And then obviously your cost price at the end of the year. So understand, land and buildings will not have any depreciation to it. Right, however, when it comes to vehicles, you have your cost price at the beginning of the year, less your accumulated depreciation. Now notice that accumulated depreciation is what we refer to as a negative asset. Why? It reduces the value of your asset. Okay, and therefore, cost less accumulated depreciation will give you your carrying value at the beginning of the year. Right, then you go into movements. What happened during the year? You could have additions at cost, purchase of more vehicles. You could have disposals. Very, very important. It's disposals at carrying value. Okay? Then you have your depreciation for the year. Notice all of these are in brackets. And then you work out the end of the year figures. Your cost price at the end of the year, less you accumulated at the end of the year, will give you your carrying value at the end of the year. Now watch this very, very carefully. When you're working downwards, it means you take your carrying value at the beginning of the year, add your additions, less your disposal, less your depreciation. This answer that you get here should be the same as your cost at the end of the year, less your accumulated depreciation at the end of the year. This indicates to you that your note is in fact correct. Okay, when it comes to your end of the year, with regards to equipment, the same thing applies. You start off with your cost, less your accumulated depreciation will give you your carrying value at the beginning of the year, right? You then bring in your movements in terms of additions at cost, disposals at carrying value, depreciation for the year, and this figure here would be identical to your cost price at the end of the year, less your accumulated at the end of the year. If you work upwards, you're going to get the same figure. Right, okay. The next note that we deal with is your inventories. What are inventories made up of? They are made up of your trading stock plus your consumable stores on hand. Okay, remember we said consumable stores on hand, those items that we have counted at the end as per physical inventory. Your trading stock obviously will have any adjustments that you may have incurred through the year in terms of a trading stock deficit or a surplus. So that would then give you your note, namely your inventories note. The next note you will be dealing with is trade and other receivables. Look at this one here, very important. You start off with your net trade debtors. Remember, again, a calculation. If you recall from our previous lessons, any further bad debts that you wrote off will then be taken into account to give you your net trade debtors. Bringing in your trade debtors, right? Less provision for bad debts, okay? That would obviously, if you work out, that would give you your net trade debtors. You bring in your income receivable or accrued income. You bring in your prepaid expenses. You bring in, very important, any deposit on water and electricity. And if there's an insurance claim where you have made a claim against the insurance company, they've acknowledged the claim but haven't paid you as yet, that would also appear under your note, trade and other receivables. Okay. The next one that we look at is our cash and cash equivalents. Under cash and cash equivalents, you're looking at one, your fixed deposit. Which one? Which fixed deposit? The one maturing within 12 months, right? Then you have your savings account, your bank account, your cash float, and your petty cash. So all of these would form part and parcel of your cash and cash equivalents. Okay, the next item that you look at is your capital account. And in your capital account, it's your balance at the beginning of the year, any contribution during the year, any withdrawal of capital during the year, drawings. Notice these two negatives, and that gives you your balance at the end of the year. Okay. The next item that we look at is our trade and other payables. And here we start off with our trade creditors, namely creditors control. Then you bring in your accrued expenses or expenses payable, your income received in advance or your deferred income, right? Creditors for salaries, PAYE, pension fund, medical aid, UIF, the current portion of your loan or your short-term loan, and a very important one here is your deposit from your tenant. If you have received any deposit from your tenant who is leasing our property, that is regarded as a current liability and therefore under my trade and other payables. Okay, so those are all the components that we have dealt with in terms of the notes to the balance sheet. So you can see that before you actually complete the face of the balance sheet, you first have to do the notes to the balance sheet. Now, just before we conclude this segment, remember, if the notes are not asked for, then you have to show calculations as to how you arrived at certain answers. Okay, guys? So that was just a taste, a starter to the balance sheet, where we looked at the notes of the balance sheet. You want to know more? Stay with us, and we'll see you just now. Welcome back, Ashraf's Accounting Stars. Yes, we're busy with the balance sheet. Quick recap. Remember we said we had our financial year end where we were given adjustments from our pre-adjustment trial balance. We completed the adjustments and drew up the income statement, right? Thereafter, we drew up our post-adjustment trial balance, and now we're busy with the balance sheet. So, we've already looked at the notes to the balance sheet, right? Let's look at the face of the balance sheet now. So, remember, learn the format. Also, if certain notes are not asked for, then show all calculations on the face of the balance sheet. For example, let's start off with the face of the balance sheet. What do we have? You start off with your non-current assets, right? Remember we did note number 3, which was my tangible asset. So there's note number 3. I bring in my tangible assets, okay? I then bring in my financial asset, which is my fixed deposit. But be extremely careful on this one here, because the fixed deposit, here you will have the one maturing over a period greater than 12 months. Okay, because remember, that portion that is maturing within 12 months falls under cash and cash equivalents on my face of my balance sheet. So it would be the amount of the fixed deposit, whatever it may be, less the portion that's maturing within 12 months. And that's important, people, very important accounting guys. Remember, that then gives you your fixed deposit. So in other words, greater than 12 months. Appears on the face of the balance sheet where? Under your non-current assets. Okay, you now add these two components, and that gives you your non-current assets, the total. Okay, this is important because you will see how we take the different components to get our final total. Okay, then we come to our current assets. It's inventories. We've dealt with this note in detail already. I've given you the breakdown of the notes already. Then you have your trade and other receivables. We've dealt with that note as well. Then you bring in your cash and cash equivalents, that note as well. Notice, these are your note numbers here. indicating that if any reader wants to know what did you have in inventory, they will refer to note number 4, and then obviously all the information regarding inventory in the form of trading stock plus consumable stores on hand would appear in your note number 4. Just a bit of advice: if you are asked to do the face of the balance sheet and there was no note asked for cash and cash equivalents, but you would then indicate that entire note in the form of a calculation indicating how you arrived at your final answer. So this will then give you the total of your current assets. You would add that up. Okay? So your non-current assets plus your current assets will then give you the total of the top half of your balance sheet, namely your total assets. So what makes up your total assets would be 1, your non-current assets. What makes up your non-current assets would be your tangible assets plus your fixed deposit. Add the 2 gives you non-current assets. You then come to your current assets. What makes up your current assets is inventories, receivables, cash and cash equivalents. Add that up. Add the 2 components, non-current plus your current, and that gives you your total assets. That's the top half of your balance sheet. Okay. Let's go to the bottom half of the balance sheet, which is made up of equity and liabilities. Remember, this is the balance sheet of a sole trader, right? Obviously, if the business is a partnership, there would be a slight change in the notes for equity. So please, my appeal to you is, if you're looking at the balance sheet of a partnership, this is where the change takes place, and please have a look at your textbook, at your learner support material, and look at the note for capital where it applies to a partnership. Right, so your capital note, again, we've discussed this note in detail in note number 7. This will give you the total there, and obviously that will be the same total for your equity. Now you come to your non-current liability, and we've alluded to this one in the lesson on the income statement, and when we spoke about the loan. Remember that your loan must be separated into 2 components. What are the 2 components of your loan? Your non-current liability, that means payable over a period greater than 12 months, and then your short-term loan, the loan that must be repaid within 12 months, also appears on the face, and you can clearly see it here, the short-term loan. I'm going to do this by way of an explanation so that you know exactly what I'm talking about. So let's take, for example, we have a loan here, and let me open the bracket, and we say the amount is 200,000, and you are told that 50,000 will be repayable within 12 months. So you take your 200,000 minus the 50,000, which will give you your loan figure here of 150,000 Rand. You're showing your calculation. Can you see that? Okay, now that 50,000 that you've subtracted from your non-current liability must now become your short-term loan of 50,000 Rand. Can you see what you've done? Your loan is still 200,000, but you've changed the placement of the loan into 2 components, namely the period greater than 12 months, the portion payable over a period greater than 12 months, and the short-term loan, in other words, the loan that is payable within 12 months, appears under my short-term loan under current liabilities. Okay, so this then gives you your non-current liability, and that's the total of your non-current liability. You now move on to your current liabilities. Right, what's your current liabilities? What constitutes current liabilities would be 1, your trade and other payables. Remember, there's an extensive note to it. So make sure you know that note and know exactly what goes into that note. Then you bring in your short-term loan. I've explained that already. And you bring in your bank overdraft. These 3 components will then give you your non-current current, your current liability, sorry. That if you add up your, let's do that again, add up your trade and other payables plus your short-term loan plus your bank overdraft, and that gives you your current liabilities. Now, add the three components. What are they? It's equity plus non-current liabilities and your current liabilities. Add those three, and that gives you the total of your total equity and liabilities. Now, also remember that this total equity, this figure you get here for total equity and liabilities, this one here, has to be the same as your total assets, because the top half of your balance sheet must be equal to the bottom half of your balance sheet. And very often in an assessment or in an exam, you work out the total assets or you work out the total liabilities, and then you take that figure and you use it as your total assets figure here, and then you then work out missing components of the balance sheet. Remembering this, that your total assets has to agree with your total equity and liabilities, and that's a very, very important consideration when you are doing the balance sheet. Okay. We now move on to information that we have and we are expected to do to work out certain missing figures. Starting off from note number 3, you are told to calculate the carrying value, that's A that we're going to be calculating first, right? And you can clearly see that you are given information in terms of additions. There was an addition of 325,000 during the year, and you have a carrying value at the end of the year of 2,550,000. You are expected to calculate that missing figure, namely A. What do we remember about land and buildings? Remember we said earlier in our lesson, we alluded to the fact that land and buildings do not have depreciation. So we know that, right? So therefore, if we're doing this calculation, we say that, let's go to the calculation. We'll come back to that information there. That's the one we're working with. Remember, we're calculating the value of our land and buildings here. That's the A, that's the missing figure. We start off by saying, fine, my closing balance is 2,550,000. That's my closing balance. That's my balance when? At the end of the year. Right. What happened during the year? During the year, I purchased additional land and buildings to the value of 325,000 Rand. They want to know what was the value, or the question requires you to calculate the value of your land and buildings when? At the beginning of the financial year. Okay, so here goes. You start off with your 2,550,000, which is your closing balance, right? This one here, 2,550,000. Then you subtract the 325,000 because that was the land and buildings that were purchased. Can you see? Additions of 325,000. So in other words, it's what we call a reverse operation. You're working backwards. You're working from the end of the year to the beginning of the year. So normally you add downwards. When you're working backwards, you subtract. It's called the reverse operation. So 2,550,000 minus the 325,000 there, and you will see that the value of your land and buildings at the beginning of the year was 2,225,000. In other words, this figure here, that one there, is your 2,225,000. And what did we do? We started with the year-end balance minus what we purchased. Remember what I said? Reverse operation. Normally, when you're working with a note, you're working downwards. So it would be your opening balance plus your additions to give you your closing balance. But if you don't have your opening balance, but you have your closing balance, as is the case in this question here, you reverse, you subtract to find out your opening balance. And here you can see my opening balance is therefore 2,225,000 Rand. Got it? Brilliant. Let's move on. Now we are asked to calculate the depreciation of vehicles on the 28th of February 2020, the total depreciation. Okay, what do we know? Clearly we can see that we have vehicles, the cost price of which is 350,000, right? You have an accumulated depreciation of 315,000, therefore giving you a carrying value at the beginning of the year of 35,000 Rand. So the carrying value at the beginning of the year on my old vehicles would be 35,000 Rand. I can also see from my information that I had purchased an asset to the value of 422,550. That was a new vehicle that was purchased during the year. Right, okay. This therefore means that, let's just look at this information that we require in terms of our vehicles. We are told that the company has 2 vehicles. Depreciation on vehicles is calculated at 20% per annum on cost. Okay, now remember, when you are working with depreciation on cost, it's indicating to you that you must calculate depreciation on the cost price of your vehicle, because that's the policy of the business. We are depreciating 20% on cost. We are also told we have 2 vehicles, right? One of these vehicles was purchased on the 1st of September 2019. Very important date that we're dealing with here. Okay, so let's go into my calculation. Firstly, I take my new vehicle, right? The value of the new vehicle was 422,550. Therefore, 422,550. Remember, I'm using art, amount, rate, and time, right? It's the cost price. It's a new vehicle, so the cost price is I keep on saying 4 million, sorry guys, 422,550 times the rate, which was 20%. I showed you, they told you the rate of depreciation was 20%, and the time. This vehicle was bought on the 1st of September. So September, October, November, December, January, February, which is my year end, 6/12. Whenever you are doing a depreciation calculation, remember, take into account the 2 components of your depreciation, old and new. So this is the new vehicle. Work out the timeline for that vehicle. That means the amount, 422,550 times the rate, 20/100, times my time, which is 6/12, to give me a total value of 42,255. That was the depreciation on the new vehicle. Got it? Brilliant. Now you come to the old vehicle. If you take 350,000, which was the cost price, let's verify that. Check. There's the cost price of the old vehicle, 350,000. Okay? And you multiply it by 20/100, and you use it for the entire year. So 12/12, which is equal to 1. Although it's not shown there, you could have put in 12/12. Obviously, you know that's equal to 1. Gives you a figure of 70,000 Rand. Okay, watch this one very carefully. If you look at the carrying value of the vehicle, you only have 35,000 Rand as the carrying value, indicating to you that the maximum depreciation that you can write off on this vehicle cannot exceed 35,000. In fact, it cannot be equal to 35,000. It has to be less than 35,000. So when you are faced with a question of this nature, the first thing that you do, right, is ignore the 70,000, meaning you can't work on the 70,000 anymore as your depreciation, so ignore it. Go back and look at your figure, which was 35,000 Rand as your carrying value, right? Minus 1 Rand from it. This is the case where you are left with a carrying value of 1 Rand, right? Minus the 1 Rand from it, so definitely the total amount of depreciation, or the maximum depreciation that you can write off on this old vehicle, is 34,999 Rand. Once again, guys, first do the calculation. Take your 350 times your 20% times 12 over 12 will give you 70,000. Now compare that with your carrying value. Notice that it is greater than your carrying value. You can't have an asset with a negative value, because by definition it's no longer an asset. So therefore, take the 35,000, which was your carrying value, minus 1 Rand from it, to give you a maximum of 34,999 Rand. That's the maximum depreciation that you can write off on the old vehicle. So therefore, 34,999 plus the 42,255 Rand, which we wrote off on the new vehicle, add the two together, and the total depreciation on vehicles would be 77,254. Okay, guys, you can see quite comprehensive, but once you set out your work in such a way, you will definitely be able to get to the correct answer. There's some more questions that we have on the balance sheet, and I'm sure you want to know more. Let's take a quick break, let's refresh, and see you after a while. Welcome back, Accounting Stars. That's right, Ashraf's Accounting Stars. Remember, we're busy with the balance sheet, and we're busy with an interesting question on the note number 3, where we have to work out missing figures. Okay, obviously this ties up with the section on fixed assets, namely asset disposal. So you can see that you have to know the section on asset disposal, even if the question is based on a balance sheet type of a question. Right, let's get right into it. We are now expected to calculate the carrying value of your vehicles on the 29th of February 2020. Let's look at this once again. Here we have the information. We have to calculate this figure here, namely the carrying value of my assets at the end of the financial year. Okay, what do we have? We know that we had assets at the beginning to the value of 35,000 Rand. So you start off with your 35,000 Rand, right? That was the carrying value of my assets when? At the beginning of my financial year, right? Then I went in and said, okay, fine. I then purchased an asset to the value of 422,550. So I bring that one in, 422,550. That was my addition of assets during the year, right? And then, obviously, you can see here, in terms of the information that I have, that there was no disposal. That means we did not sell any vehicles during the year, and it is pre-populated, telling you that it's a 0. And obviously, you now bring in your depreciation, right? That's clearly one that we have calculated already. That's B. Remember, that is something that you've calculated, and let me show you the calculation so you can see it. Here we go. There's my calculation of my total depreciation, 77,254. Therefore, bring that in minus your 77,254. That was your depreciation that you had calculated already, taking your 35,000 plus 422,550 minus your depreciation, because as you can see here, your depreciation is something that appears in a bracket. It's something that we've calculated already, and therefore giving me a figure of 77,254. So 35 plus 422,550 minus 77,250 will give me my final answer. That means the carrying value of my vehicles at the end of my financial year amounts to 380,296. Okay. Next question. Calculate the carrying value of the equipment that was sold on the 31st of December 2019. Let's look at the information that we have. Firstly, you can see that your equipment on hand at the beginning of the year, the cost price was 460,000, and the cost price at the end of the year is 340,000. You know for a fact that there was no equipment bought because you are told that that's a zero. So clearly, if you had equipment to the value of 460,000 at the beginning of the year, and you've only got 340,000 at the end of the year, clearly indicating to you that you have sold equipment with a cost price of 120,000 Rand. And how do we get the 120,000 Rand? 460,000 minus the 340 will give you a figure of 120,000 Rand. Okay. Then you are told that this vehicle here, sorry, not the vehicle, the equipment was sold. It was purchased on the 1st of March 2018, right? And it was sold on the 31st of December 2019. We're getting all of this information from our fixed assets register, right? Just a bit of information on the fixed assets register. Remember, your asset account, as it appears in your balance sheet or in your ledger, doesn't give you specific details about a particular asset. For example, look at this here. The total value of my equipment is 460,000 at the beginning of the year. But what makes up, what constitutes the 460,000? That information is gleaned from your fixed assets register. So if you want to know specific asset values, you'll have to go to your fixed asset register and get the information regarding that particular asset. Okay, so here we have that asset. We have the fixed asset register in front of us. We know that it's an equipment and it was originally bought for 120,000. You can see that. So you can actually use that to verify our calculation. So we've got the cost price, and it is depreciated at 10% per annum on the diminishing balance method, meaning reducing balance method. So cost price minus accumulated depreciation will give you your carrying value. So here we go. We say, fine, in the first year, it was 120,000 times the rate of depreciation here, 10 over 100, times 12 over 12, gave you a figure of 12,000 for the first year. 120 minus 12 gave you a value of 10,000 or 108,000 Rand was the book value at that point. Okay, now you come to February 2019, the second year. Remember, the amount now will be 108,000 times 10%, 10 over 100 times 12 over 12. And if you do that calculation, you're going to get a figure of 10,800. Okay. Okay? That then, if you take that figure and you work out now, you have to calculate your depreciation. Watch, this is important. You now have to calculate your depreciation on your carrying value, right? Okay, and what is my carrying value? Obviously, the 108,000 minus the 10,800 will give you your carrying value at the end of the second year. And then you have to go and calculate your depreciation up to the 31st of December 2019. Okay, I'm going to show you the calculation. I've got it done for you already. So here we go. Here's my calculations. Right. So before we come to this here, let's go to this one here. I want to show you this here. The cost price of the equipment was 120,000 Rand. The accumulated depreciation on that equipment at the beginning of this financial year was 22,800. And where did that come from? That came from this figure here. As you can see, 12,000 plus the 10,800 gave me a figure of 22,800. Therefore, this calculation is of extreme importance whenever you are dealing with an asset disposal. So there's my 22,800 of this financial year. Okay. Then you worked out your current depreciation, and that worked out to 8,100. That was the current year's depreciation. Notice that that's your depreciation for your current year from March, from the beginning of the financial year until December. Okay? So you work out pro rata depreciation. Okay? And that is based on the carrying value of the asset. You work out the amount, the rate, and the time, like we've done for all our depreciation calculations. And the answer that we get here is 8,100. What is that? That's the current year's depreciation on the asset that we are disposing of. But remember, when you're working out your time component, it starts on the 1st of March, right? And ends in December, because that's when we sold the asset. If you look at the information, you will see it here. This asset was sold on the 31st of December 2019. Okay. Coming back to my calculation, so then I add the 8,100, which is my current year's depreciation, to my opening balance, which was 22,800, to give me a figure of 30,900. That's the total accumulated depreciation on the equipment that we are disposing. Right. So now I take my cost price of 120,000 minus the 30,900 will give me my carrying value of 89,100. So this calculation here, obviously the selling price of this asset, they gave it to us here. It was sold for 81,250. The selling price was 81,250. Now here, once again, although the question doesn't ask for it, I'm just going to show it to you. The selling price was 81,250 and my carrying value was 89,100. So obviously you sold for less than the carrying value. When your selling price is less than your carrying value, then you are making a loss on sale of asset. This will indicate a loss. Why? The selling price is less than my carrying value. If my selling price is greater than my carrying value, obviously, then I'm going to be making a profit on sale of asset. Although the question doesn't ask for it, just by way of an explanation so that you understand it. Okay. Let's go back to our answer. Watch. I want to show you the calculation that I have done in relation to the expected answer, so you can understand where it's coming from. There's my 120,000, my cost price, minus the 12,000, that was your depreciation for year 1, depreciation for year 2, and then the current year's depreciation, the 3 components. Can you see 12,000 plus 10,800 plus the 8,100? If you subtract that from 120,000, you're left with 89,100. That's exactly what we had here. 89,100 was my carrying value. Okay. Now you are expected to calculate the total carrying value of fixed assets on the 29th of February. Once again, look at what we have here. There's my land and buildings, 2,550,000, right? Remember, I calculated my vehicles figure. I'll show you the calculation just now. And the equipment of 50,994. Going back to the vehicles, just to pick up our figure there, we calculated it. Remember, it was, where's that figure? Let's get it here. The total value of my vehicles there, was it? 380,296. Therefore, look at my answer here. Here we go. The 2,550,000, which was land and buildings. That's my vehicles, and this is my equipment. So what do? I add all the carrying values to get the total carrying value of my assets. Once again, land and buildings, vehicles, and my equipment to give me a total value of 2,981,290. That's the total value of the carrying value of all my assets. Right, guys? So what are my balance sheet components? Remember we said these two would go to my income statement, right? All of these would fall under the balance sheet. What are they? Tangible assets, inventories, trade and other receivables, cash and cash equivalents, my capital, and trade and other payables. Okay? Very important. Fixed deposit, separate it in your balance sheet. Greater than 12 months, under the financial asset, less than 12 months, under cash and cash equivalents. Right? Also remember, separate your non-current liabilities into its two components. Non-current, greater than 12 months, under non-current liabilities, and then your current liabilities, your short-term loan, payable within 12 months, under the short-term, namely under your current liabilities. Just a bit of discussion here. Remember, sometimes the short-term loan can be shown as part of trade and other payables. Sometimes it's shown on the face of the balance sheet. Look at the question, it will give you direction. Okay, and then the total fixed assets must be equal to my total equity and liabilities. Remember what we said? The two halves of the balance sheet, the top half, total assets, it's your total assets, which is made up of your non-current assets, your financial assets, your current assets, all the assets added together will be equal to your total equities and liabilities, and you know then that your balance sheet is in balance. Okay, guys? So once again, remember, let's encapsulate what we've done in today's lesson. You start off with your pre-adjustment trial balance, do your adjustments when financial year end, prepare your income statement, do your post-adjustment trial balance, and conclude with your balance sheet. Well, guys, that's it for the balance sheet. Once again, practice, practice, practice makes perfect. From Ashraf and the team, we want you to aim for the moon, and perchance, if you don't get there, definitely you will be an accounting shining star. Ashraf's accounting shining star. Until next time, be good. Goodbye.